I'm joined today by Ray Carroll, Managing Director of Neuberger Berman. Ray is among the incredible investors sharing insights at the Family Office Investment Forum today. Welcome, Ray. It's great to have you with us.
Thank you, Zelda. It's great to be here.
Ray, what are the biggest investment trends you're seeing among family offices globally?
Yeah, there's a couple of things. There's the growth of privates, and then in public markets, where I'm focused, we see people really focusing on tax-managed equities. And by that, I mean equities that are designed to be customized to individuals' cost base and tax situation, aiming to optimize their after-tax returns, not their pre-tax returns.
Right. So, what exactly is tax managed investing and why is it of interest to family office investors?
Tax managed investing really involves holding a separately managed account where you individually hold specific securities rather than pooled vehicles. And what that allows asset managers like myself to do is make investment decisions taking into account each individual client's cost base. So in other words, the client that invested in Tesla earlier this year might not mind if we sell those Tesla shares because they'll be at a loss and reduce his tax bill. But the client that bought Tesla 10 years ago might have a lot of unrealized gains. And if we sell down that share, he'll actually have a tax bill. So we consider each individual situation in order to optimize after-tax returns.
Fantastic. And does tax managed investing apply to active equity strategies or just passive index investments?
Yeah, historically, it's best known for passive investing, but our particular focus is in active investing. And in particular, we think active investing is not always as tax efficient as passive. And so that's where you can actually get the biggest boost from applying these tax managed approaches.
Can you talk about the growth of tax managed active extension strategies in equities investing, such as the 130/30?
Yeah, 130/30 or active extension has become popular lately. It's actually really exciting. We think that it can create about 3 times the amount of tax loss harvesting as long only. So that can be really powerful for clients that have a large capital gains tax bill to manage. That might be clients that are selling their operating business or clients that have a large concentrated portfolio that they want to diversify away. So we think it's a really powerful tool going forward.
And what are the most important things for Australian family offices to know about tax managed equities investing?
Well, the first thing I believe they already know, but it's never hurts to reinforce that the difference between pre-tax and after-tax returns can be very large and compounded over the multi-decade or even multi-generational life cycle that family offices typically have. That can make a huge difference in actual wealth creation. The second thing they should know is that even though tax managed equity investing is not as popular here as it is in the US, where it's nearly $1 trillion business, the tax regime here really does support tax optimization along the lines I just described. So what they should know in the end is that if they're in the highest tax bracket and are looking for a way to reduce the taxes they're paying, there are tools that they can turn to.
Thank you, Ray. We'll have to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Family Office Investment Forum.
Yeah, thank you, Zelda. It's been a pleasure.